Well, let's get a top-down view on the markets. And after the RBA confirmed they would be increasing QE and extending it for another 6 months, there's now even more money potentially sitting on the sidelines waiting for a home. To find out where it might be, we're joined by Henry Fung from MF&Co Asset Management live here in the studio. Henry, welcome back to the program. RBA yesterday, no real surprise that it extended its QE program, but very dovish in that we've seen it preemptively go and move that, and we also saw that say that it's not planning to go and move the cash rate at any point until at least 2024. Yep. That's going to be an environment that's got to be conducive for equity markets, you'd imagine.
Yeah, that's right. I mean, I think we're probably heading into a situation where we're going to have quite a strong bull market once this COVID thing sort of dampens down and we start to get into control around the world. Main view towards that is because just before 2008 in the US, we're pretty much at that similar spot, just before these unconventional policies start ramping up. And after that, obviously, we know that was the biggest bull market we've ever had in the US. Australia is probably approaching that. We're going to see a massive property boom as well because of the low interest rates. We've already seen that. It's not a lack of properties at the moment. It's just so many buyers coming in, low interest rates, huge mortgages. So I think, we are heading into a pretty big bull market.
Okay, interesting, because we are now hearing federal politicians talk about austerity in some way, shape or form, worried about ballooning public debt and deficit yet again. Do you think that there is the chance that policy risk on the fiscal side could dampen things?
There's always that risk, but if you look in the past in history, they have to come out to say that. They have to look like they've been responsible. But the fact of the matter is, what happens in the markets, what happens to people in Main Street, that's what drives what the decisions will be. If they cause, mass job losses or, mass closure of companies and so forth, they're going to walk back on that. So, they can't be completely dovish and bullish. They have to have some sort of counterweight towards that as well, I think.
So Henry, let's make a couple of assumptions. So we know that monetary policy is going to be pretty much easy for the foreseeable future. We get the vaccine rollout underway here in Australia. Things go okay, like we've seen over the past 6 months or so. How are you playing it from an investment perspective here locally?
So at the moment, I think there's probably two main things. The first one being the bullish view that I have in terms of the monetary policy. The other probably main risk at the moment that I'm seeing is at the end of March, we're going to see Jobkeeper being cut off, as well as the loan deferrals being cancelled as well. So there's quite a lot of risk coming into that. Scott Morrison's come out and said we're not going to write in more blank checks. And of course, RBA 24 hours later comes out with $100 billion injection. So there's a bit of conflict in terms of those two types of policies. The way I'm playing is at the moment, going into sort of mid to late February, I'll be net long. And then if they don't come out with a bit more dovish sort of policies, I'll probably start to hedge going into, say, the market holds 6,800, sort of 7,000 level. I don't think we're at the 7,000, but if it holds this 6,700, 6,800 level, I'm starting to feel that the risk is way more to the downside. And at least do a short-term hedge to get past that sort of end of March area.
So are you looking more favorably on what area of the market? On mid caps, on large caps? Where do you see the opportunity?
Yeah, at the moment, it's hard to see the opportunity because we're trading at pretty much the same level we were pre-COVID. Obviously, pre-COVID went to 7,000, but that was just a massive sort of uptick at the end of it. But at the moment, I focus towards sort of more dividend type stocks. As you mentioned earlier, there's quite a lot of pent up money that's looking for yield. If you're getting term deposit, getting nothing with term deposit. Australians, for some reason, love term deposits. They don't really go into bonds or corporate bonds where you can up the risk level, up the yield, but not necessarily move into equity risk. So you'll probably see a lot of flooding back into the usual suspect of dividend payers like your banks, your miners, that sort of mature type companies who have shown in the past that they have consistent dividends.
When it comes to a preference over large and small, do you want to be in the large cap or do you want to go and look for opportunities further down when it comes to size of companies out there?
We usually do both, but I'm really right now. I think if someone doesn't have that sort of large cap base of stocks that can pay good dividend, and they're looking to do it now, just wait for the dips, buy into it, just get it done. Mid cap, I'm still quite bullish on, especially things that are focused around the recovery of the economy after the COVID thing has sort of run its course. So I'd rather take a little bit more risk on the mid cap side, betting on COVID being contained and our economy getting back to where it should be in terms of that.
Well, Henry, it's been a pleasure to have you joining us.
Thank
We
you.
really appreciate your views. We'll
Sure,
talk
thank
the
you.
banks next time in a bit more detail.
Cheers.